Hello, Realtors. It's Joe Taylor with Marketplace Title. And David Burt and I wanted to talk with you for a moment about Realtors investing in a title company. There's been a lot of title companies calling Realtors lately and asking them to invest in a title company. And we wanted to objectively talk to you about it because that's what we've done as a title company for many years, is to help Realtors and consumers navigate the complexities of title and things like that. It's been going on for a while now. This is not a new thing, right, David?
Yeah, we've been hearing about it for a while.
For a while.
It seems to be accelerating maybe even.
Right. So we're going to tell you objectively what we think about it so you can make a great decision on whether it's for you or not, okay, Realtors? But first, let me tell you a little bit. Most of you know us. My name's Joe Taylor, and I started Marketplace Title about 17 years ago, back in 2007. So I made it through the real estate crash of 2008 and moved my company, Marketplace Title, from Fort Myers to Estero in this building 13 years ago, back in 2010. So, and as a result of the crash, there were some changes. You probably have heard of the Dodd-Frank Act.
Yeah.
Right, that came out. It was around 2010, and it was to protect consumers, to make sure that this crash won't happen again. And there a lot of rules and regulations came from it, but one of them was, I think, the Consumer Finance Protection Act.
Yes.
And then the Consumer Finance Protection Bureau, which is the regulatory agency that enforces that act. So as a title company, I saw an opportunity. Well, let's go ahead and educate Realtors on what those changes mean for buyers, sellers, and so forth. And then not too long after that, there was another rule that came along, and that was the TILA-RESPA, integrated disclosures. You know, when that happened, they integrated the Truth in Lending Act and the Real Estate Settlement Procedures Act, which really regulated HUD and so forth. So we did that. But about 6-7 years ago, when did you join, David?
I've been here 7 years.
So David Burt is a real estate attorney. I'll let him introduce you, but he joined our firm 7 years ago, and it's been fantastic because it fits right into what we want to do, and that is to be compliant. We want to make sure we're doing everything right, following the American Land Title Association best practices. So David, he's our Vice President of Operations. He's a real estate attorney. Tell him a little bit about what your role is and what you've done.
Sure. So, as Joe said, I'm a real estate attorney. I've been practicing law here in Southwest Florida since 2001 when I was admitted to the bar. I've been doing real estate related law for the majority of that time, and as we said, I've been in the title business for 7 years. When I joined up with Joe, it was I sort of took on the responsibility of making sure we complied with all of the regulations, and also, tried to make our operations efficient, but in a way that was always compliant, and to ensure that we provided the best service.
Absolutely. He's been a huge asset. And the fact, Florida, you don't need to have a real estate attorney to close real estate transactions in Florida. You need a licensed title agent, which we are. But to bring an attorney on staff, to have them in your office, it adds quite a bit of credibility, but mostly peace of mind for clients, because a lot of northern clients are used to working with solely attorneys.
Sure.
Yeah.
And agents, questions always come up that are of a legal nature, and you can't, as a title agency, Marketplace Title ordinarily isn't allowed to provide legal services, but myself being a licensed attorney, I'm able to chat with agents and answer quick questions, give quick consultations, and try to keep the process moving forward efficiently.
So in line with what we have done over these many years of building clientele is through just trying to it's been a big goal of mine. How do we make it so efficient and help Realtors? So that's what we want to do here. Again, we just want to give you an objective view on a lot of realtors are getting called from these title companies. A lot of them are just coming into the area in the last couple of years, and they're calling realtors and say, hey, invest in our title company and you'll get a return. And we have actually looked into this extensively, so we just want you to know we have a lot of experience in this, and we want to be objective, and then we'll give you our opinion as well a little bit, but mostly we just want to help you out if you're ever considering this. So David, what is a joint venture, I guess, or just tell us what's going on with
the whole issue that we're talking about. So there's an obvious benefit for us operating a title company. There's an obvious benefit to being able to partner with agents, because we depend on referrals from agents primarily as the source of our business that keeps us going, as opposed to we want those purchases and sales referred to us as opposed to our competitors. But many years ago, before marketplace title started, the federal government passed or the Congress passed laws saying you can't, as a title settlement services provider, which is what we are, we're not allowed, as a general rule, to give compensation to anybody who's in a position to refer third parties to our services. So, primarily that being real estate agents, could also covers things like mortgage lenders or builders, anybody who's in a position to refer business. We are not allowed to give anything of value in exchange for those referrals. That is the general rule. Back in during the 1990s, though, there was some noise from the industry saying, well, there might be situations that don't run afoul of sort of the public policy interests in preventing those kind of what we call kickbacks. And so as a result of that process, Congress amended, the law that applies here is the Real Estate Settlement Practices Act, or RESPA. So Congress amended RESPA to say, okay, under these specific circumstances, we're going to say that these arrangements are not a violation of the prohibition against kickbacks. And it's very specific. There's basically three standards that if there's a business arrangement that meets these three standards, then it doesn't violate the kickbacks prohibition. One is there has to be a disclosure up front of what the relationship is, and which includes an estimate of what the consumer will pay for any of the services provided by the affiliated company. Second is the consumer cannot be required to use the affiliated company. They maintain the choice. And third is that the only thing that an affiliated, a person that refers business, like a title agent or like a real estate agent, the only thing of value that they can receive is a return on an ownership interest in the affiliated business. So that was, it's sometimes referred to as a safe harbor provision, because the idea is, as long as you comply with the standards that are specifically set forth in the statute, that you're not going to be held liable for a violation of the statute.
And certainly these realtors, and you probably have seen this, realtors, your brokerages out there, there are a lot of independent brokers right here in Southwest Florida that own an interest in a title company. And you've seen this because you have to provide that ABA disclosure saying ABC Realty Brokerage Company has an interest in a lender and a realtor, and you've seen that. So you probably think, well, why can't I own a piece of that and get paid directly? Well, you can, but you would have to provide another disclosure. So you would have to have two disclosures, one from your broker and one from you to your buyer, saying, hey, my broker can make some money on this referral and I can make some money. Okay, so that's the first thing. But so that's probably the attraction is, hey, my broker's doing it, why can't I? So
Sure.
So yeah. What are some of the other things? So if a title company calls me and says, hey, and they're asking them to invest $1,000, $2,000. I've heard as much as $5,000, and you'll get a return every quarter or so. But doesn't that have to be exactly based on the exact percentage? How does that work? The company.
Yeah. So there's a lot of guidelines. So the statute itself sets out those 3 guidelines, and people refer to it as a safe harbor. For my own, in my own opinion, I don't like to call it a safe harbor, because frankly, you could look at a proposed arrangement that somebody proposes to you and say, okay, go down the list, those 3 things. On the face of it, it looks like it complies with that, so you're safe, right?
Well, it could appear that way.
Fact is, you're not. That's only the very tip of the iceberg. That's not the end of the inquiry. So one thing in particular that back when RESPA was first passed, it was the Department of Housing and Urban Development, or HUD, that was enforcing it after the reforms, after the Great Recession.
Oh yeah,
the Consumer Financial Protection Act created the Consumer Financial Protection Bureau, and responsibility for enforcing this law was assigned to the CFPB.
And they're self-funding, by the way. So the way they make money and operate is they fine. They go out and fine people and companies, and
yes. Just interesting note, Joe, is the news just came out recently that the CFPB is increasing their enforcement staff by 50%.
There we go.
They're in the process of doing that right now.
And I'm sorry to get in the middle, but right here, we've done this. We have created an affiliated business arrangement. So we have experience in this. So that's another point. We're not trying to dissuade you. We're just trying to give you some objective information, because it's very important. You're going into business with a company that called you on the phone and asked you for money. Okay, so that's the first thing you got to look at. Yeah. So should we tell them about the business that we did?
Well, yeah, and just to follow up on that, when we first, when this first sort of came to our attention, we looked into it right away, because it seems like an opportunity.
Correct.
And we're not ones to pass up a good opportunity.
That's right.
And also in line with our philosophy of, keeping our referring partners, our title agent friends and business sources informed and also protected. We wanted to look into it and see if it was a good opportunity. And at the beginning, when we first looked into it, we were kind of saying, no, there's too much. Yeah. There's just too much there. That's there's risks involved, and you have to be very careful about how you go about doing this, if you're going to do it at all.
So we sought out the number one attorney. Of course, that's what we're going to do. We're going to surround ourselves with experts, like we always do. Gentleman out of Louisiana, and he didn't work for the CFPB.
No.
He defended people that were brought fines and so forth, charges from the CFPB, and so he's defended people, and so naturally he's in the business of helping create these ABA agreements based on what he's seen from defending people, right?
That's right.
And so so we had him put it together, an agreement, and I guess $15,000-$20,000 later, and learning a lot about it, we started a company over in the Cape, and it suited the situation because the people we partnered with, they had 35%, and we'll do all the title work and do the licensing. You have to start a whole new company. That's the other thing. You can't just invest into an existing company. Well, you can, but you could, but if it's capitalized or if it's valued at $2 million and they're saying you're getting 1%, they better be asking you for $20,000. You see how that works?
Yeah.
So.
Yeah, the advantage of starting a new company is there's no history of income to look back on to jack up the value and the cost of your investment or the share you're getting.
And it's not a hard and fast rule, but 100,000 seems to be, the number to start a title company here to get it going and be properly capitalized. I guess the rule would be 5 or 6 months of operating expenses. And so these builders, what they were doing, they're finding investors over, particularly in Northwest Cape, Lehigh Acres, Port Charlotte. There are a lot of empty lots, and there's a shortage of rental properties, as you know. And investors are investing with them. They're helping them buy the lot. they're getting the builder, they're putting together the lender. And so for a title company, that could be up to 3 transactions. You've got the lot purchase, you've got the construction perm loan, and then 70% of the time you're refinancing into a permanent loan, right?
Yeah.
So that's 3 deals. So one title company, and they felt like to increase the quality of their system, it would be best if they owned a piece of a title company.
Yeah.
Well, so they invested the exact amount of money, and we did everything. Tell them the things that we had to do.
And from working with the attorney that we hired, we found that that's one of the keys to really have a successful arrangement like this. Is it has to be something that's going to fill a need that's not otherwise filled in the market.
Yeah,
So,
that's a good point.
right.
Because yeah.
Yeah.
So what other little things that was a good point about what we did with that? This was a year ago, so we've been doing it a year. So we have to provide the profit and loss and everything, and any additional income that's needed. If and it's been pretty slow. We had a slowdown because we had a big hurricane over in the Cape. So you can imagine the deals didn't come in as much. And if there's a cash that needs to be infused into the company, that investor better put in 35%. We can't give anything of value. We can't use any of our employees at Marketplace Title. We can't use any of our systems. We have to have its own building, its own insurance, its own licenses, and those partners had to be approved, right, through many times.
Sure. The underwriters had to review
underwriters,
the
state
licensing
background
purposes.
checks. So there's a lot to running a title company, and it's very detailed. There are many regulatory agencies, you can imagine, that we have to abide by, and many different types of insurances and standards that we have to abide by. So
Right.
because we have to protect our partners. And conversely, what if they do something wrong? What if they provide the statement wrong?
That's part of the venture. So
that could mess us up.
The CFPB is going to come after us.
Okay,
And
there
them.
you go.
Yep.
So if any one of the partners do something wrong, so
Yeah.
it's a good point.
Yeah, and that analysis is one of the more important things, because what the CFPB, besides like I said, the 3 standards in the statute don't end the inquiry, because the HUD originally, and the CFPB has sort of followed on to that, saying that, well, just because on the face of it you satisfy these 3 things, among other issues, the agencies are taking the position that even though a bona fide settlement agency or bona fide bona fide company that provides these services and gives a return based on an ownership interest, qualifies for the exemption from the no kickbacks rule. A company that is not bona fide, in other words, is a sham or just a shell, does not qualify, doesn't meet those standards, and therefore is in violation of the no kickbacks rule.
And that's what we're talking about. We're talking about trying to prevent you from joining and this is what the regulatory call it. It's called a sham JV, okay, a sham joint venture. And they're out there. And for title companies coming into the area, they feel like, hey, how can I build business quickly without any track record, without building the relationships? It can be a good model, but it can also be some things that you've got to be aware of, okay?
Yeah. So way back when the RESPA first came out, when this whole thing first started, HUD, who was in charge of enforcing it at the time, came out with a policy statement that said, these are the things we're going to look at to determine if a company is a sham or if it's a bona fide provider of services. And there's 10 things that they look at on that question. I don't need to run through all of them, but they include things like...
Thank you.
Like,
we're not going to go through all 10 of them.
But it includes things like, is the company that's been formed, is it sufficiently capitalized? And if it's capitalized, that capital should be contributed in proportion to the interests that the members are receiving in exchange for contributing the capital. Is it staffed with its own employees? Does it manage its own business, or is it, the parent, the partner title company doing all the work and just splitting the fees out of the shell company?
You can't do that because you're giving something of value.
No, plainly illegal according to the HUD standards. Does the entity have its own office? Is it providing, is it doing the services itself? Is it providing the services, or is it contracting it out, basically farming it out to the parent again, who's doing all the work, and the company is just taking the money and splitting it between the two investors? So also, is it actively competing? It can't just rely on referrals from its, agent members or shareholders. It has to go out in the market and compete for business.
And a point I want to make, one of the title companies, it would appear that they're out competing, but they went out and joined a group called Top Producers. Well, guess what? It's because all the top producing agents are there. So you can appear to be marketing, but guess what? They're asking them to invest in their company. So it's going to benefit them. But so.
So if the CFPB now looks at your company and says, well, applies all these 10 factors and says, okay, we're satisfied that your company, that you structured it in a way, founded it, got operations going in a way that meets all of these 10 conditions, then they're going to say, okay, fine, it seems like a bona fide, legitimate settlement services provider. But then you have to go back and say, even if it is bona fide, is it still meeting all of the standards in the statute? And again, that's, make sure that the disclosure is given, and there's rules about how the disclosure is given. It has to be sufficient to meet the standards in the statute and in the regulations. And it has to be given in a way that the consumer notices it, understands it, so make sure that when you do that, basically the intent really is for you to give information to the consumer so that they understand that if you refer them to this company, that you're doing it at least in part because you have a financial interest in that company.
Correct. So they could sign a lot of disclosures, maybe at the time of signing the contract and the HOA addendums and things like that. Well, boom, there's the disclosure. It's kind of hidden in there, and that happens. But if they need to know that this is why that's in there, and it's got to be done before the service is referred, right?
Yeah,
it's like you can't send it over to title and we start working on it, and then, oh, by the way, you got this one form. Yeah. Well, first of all, you're gonna attract more attention to that form if it's later on, but you just got to do it right. So you got to do that. Is there anything else about that form?
Well, I think we could go into great detail, but basically make sure that it's detailed enough. Make sure you give it in a way that the consumer notices it and understands what it means. And then the second standard is sort of related and a corollary to that. You're not allowed to require your clients, your consumers, to use your affiliated company. Now, again, I think this is open to sort of a sham, analysis, in that, well, if you say, well, I'm not requiring anybody to use, this company I have an interest in, I just refer them, and I don't tell them they have to do that. They can go to a different company if they want to. I have my doubts as to whether that is sufficient. I think that you should take some steps to document even that your clients or your consumers know that they have a choice, that they can choose another title company, and they have, if you refer the business to your affiliated company, that they have made that choice themselves. Yeah,
that's going to serve you well if you do make a point of that, because it could come back to bite you. What if that title company has a claim or does something wrong, and that buyer goes, well, I didn't really know that you had an interest. So it's
or they'll be like, I didn't choose them. That's just where my agent sent my contract.
So And I think all realtors have been trained that way. You have your ethics classes and courses, your CE classes, 3 hours every 2 years on ethics, 3 hours of law, I think, every 2 years, and 8 hours of specialty courses. So you've got those 14 hours, and that's why they do them every 2 years, because things do pop up in the marketplace and they address those. So I'm sure they'll be addressing them more. But it's becoming more and more frequent, though. This is what's happening. In the last couple of years since the pandemic, there have been a lot of sham companies or a lot of realtors that are acting this way. I'm not saying that all of them are not legitimate. So just be very careful. Again, we're trying to give you some objective information on how to evaluate that. So I would say the first thing is, when you get the agreement, have an attorney take a look at it, okay?
Well, let me talk about the third standard, Joe, from the statute, because this one I think is the most likely to really get people into trouble.
Okay.
Good. And the third standard is that anything of value you receive from the company that you're affiliated with can only be a return on your ownership interest. You are not allowed to receive anything else of value from the company. So, what does that mean? Well, you can put on paper that, I purchased, 5% of this company, so I'm entitled to 5% of whatever the profits are, right?
Correct.
Well, what if you purchased your 5% of the company at a value that's tantamount to, in the market would be worth 0.5% of the company?
Right.
Right? So if you pay $5,000 for an ownership interest that's worth $50,000.
Oh, that's something of value, right? Okay, there you go.
Based on the returns that you're expecting or the returns that have historically been shown.
So one way.
That's a thing of value that the company has given you, and that is a violation of RESPA.
So that would be like, hey, they go after the top producer in the area and say, look, I'm going to give you you give me $5,000 for 1%, which would mean that the business is capitalized at $50,000, but they're really getting 10% of the company. That's a clear violation.
Or they're getting returns
that are equal to that. So, and on the other hand, of course, those title companies can't require you to send business. You could sign up with them and not send any business, but they're going to say, hey, why aren't you sending any business? The more business you send, the more people you tell can affect your bottom line as a realtor on your return. So it's insinuated that, in order to make money, you got to refer business. Wouldn't you think?
Right.
I mean, that's the whole idea, right?
Sure. Yeah, it is. Yeah, they can't require you to
Can't
refer
require
business,
you,
but they're probably gonna push you, especially if they start to run low on new transactions.
There you go.
Some other points on the third standard is the return you get can't be related in any way to you referring business to them. So you can't, the return you get can't be adjusted up or down based on the number of referrals you've gotten. Your membership interest can't be adjusted, after the fact based on, you referred this much business last quarter, so now your ownership interest is this, more or less.
So that brings it to the next part of it, and that is they come in and they get 10 realtors to join. Maybe they set aside, let's say 15-20%, because most of the time when you have 20% or more, your underwriter is going to want to know who are those other 20% shareholders. They're going to want to vet them, do background checks, check their credit. I mean, so it's not a big portion typically. Now it could be, but because our partners had to have a background check and be checked on the errors and omissions insurance. They had to be checked on the surety bond, the fidelity bond, the general liability insurance. What else? I mean, there's a lot. Mm-hmm. So, but my point was that they're adding more and more realtors. They're adding 50. There could be 100 realtors in on that small interest. So that means your share. That's why they call it a share, because it's now diluted. Isn't that right? Or it can be.
It's possible. Yeah. It depends on how the proposed company is structured.
And they are structured that way.
Yeah, we haven't done this. We haven't done this way,
That
but
way, yeah.
our understanding is that there are a lot of agreements out there that are structured where the sort of the manager of the venture can dilute your interest.
Correct. And I mean, I guess the thing would be, well, the more realtors you have in, the more deals. So, it could be diluted, but if you have someone that just puts in and then they don't send any deals at all, then, it could affect your return. So,
Yeah.